Welcome, everybody. Thank you very much for joining us today. We're really excited to bring this webcast opportunity to you. Joining me today for our discussion is Joanne May, Principal at Forest Asset Management.
Hello, everyone. Thanks for coming. I'll let Tyler continue the intro of Apollo.
And I'm Tyler May. For those of you who do not know me, I work alongside Joanne as a wealth management associate here. But most of you know Joanne and I. So joining us today is Apollo Lupescu, Vice President at Dimensional Fund Advisors, which most of you should be familiar with because you're currently invested in their funds. Apollo has been with Dimensional in Santa Monica for over 21 years, and prior to that, he taught at the University of California. He received his PhD in economics and finance from UC Santa Barbara, and also holds a BA in economics from Michigan State University. Obviously, his credentials and experience in the industry speaks for itself, but the reason we love Apollo is because he has a particular skill set for explaining complex issues in a clear and understandable way. So now I'd like to welcome in the Secretary for Explaining Stuff, Dr. Apollo Lupescu.
Well, hi, Tyler. Hi, John. Thank you so much for the invitation to be back. And yeah, I think we're coming about a year since I last saw you in person. So it's great fun that we're still working together. So thanks for the invitation. And thanks to everybody for taking the time to attend this.
Yeah, absolutely. Thank you, Apollo. Joanne, would you like to hop in?
Oh, yes, Apollo. What we were thinking we'd start it off with is maybe a little recap of what's happened thus far in 2025. It's been extremely busy.
Right.
And I'll just let you take it from there.
Yeah, and I think that what's crazy is that we've had such a roller coaster of a year on so many levels, and it's been emotional. It's been not just about the stock market, but so many things right now that are touching our identity as individuals, and also look at the market every single day. It's like it's up and down. It seems like it's been pretty nutty. And the good news that I kind of come here to report is that if you look at the U.S. stock market as a whole and measure whether it's by the S&P metric or Dow Jones or NASDAQ, there are different metrics, and we'll touch on those. Then the good news is that for the year, you folks have made money. So despite all the ups and downs, despite what you heard about tariffs and all you heard about all this negative stuff, the market for the year is up. The S&P 500 is up roughly about 6% or so. So it's a really nice gain for the year. But this gain, when I talk about the S&P being up, it is not across every single stock, because S&P 500, for example, which is the measure of the U.S. market, is reflective of the underlying performance of 500 different stocks, 500 different companies. And if you take a bit of a deeper look, what you see is that there are a bit of a split. There's been a bit of a split. About 59, almost 60% of the stocks, the companies in the S&P 500 had positive returns. You made money on those stocks, and about 40% of those you lost money. So it hasn't been across the board. And obviously the question is, well, could we have figured out exactly what would have gone up or down for the year? And the answer is unequivocally no. There's no chance that at the beginning of the year, anybody can tell you what stock is going to go up or down. And just to illustrate, just to make some points, you take companies that are seeming in the same business. You take Ralph Lauren and Lululemon. They're both clothing companies, and it turns out that Ralph Lauren was up about 20%. Lululemon was down about 37%. So one was in a positive, wasn't negative. I mean, you look at GM was down, Ford was up, and probably the ultimate example, Coke versus Pepsi. It turns out that Coca-Cola was positive, and Pepsi was negative. So this idea that he can somehow figure out what is going to go up or down in a particular sector, that's just nonsense. It's just completely random. But what's also interesting, that's positive and negative, and you can take a bit of a deeper look by how much. And if you look at that, that's quite interesting, because what you see is that most stocks, 123 stocks out of the S&P 500 went up in the range of about 0 to 10%. So that's the range that they were in. There were 123 different stocks that went up in between 0 and 10%. And then there are also about 104 stocks, so not as much, but in the ballpark that went down between negative 10% and 0. And the reason I bring this up is that typically what we see in the market, which is very typical for this first half a year, is that the middle returns tend to happen most often. And the more you move to the extremes, whether it's negative or whether it's positive, we still see companies with more extreme outcomes. It's just not as often. So, the most often returns that we see are towards the middle. And in this case, -10 to +10, you had almost half of the S&P in that particular range. But there were two companies that lost more than 40% of their value. And if you're curious which one were those companies, well, one of them was Enphase Energy. I've never heard of that company. It's part of the S&P 500. And the worst performer, roughly about 50% down, was Decker Outdoor. And if you don't know that company, maybe you know their products. Hoka shoes, Uggs, didn't do very well. Last year was one of the best performers. Now it's one of the worst. But what's also interesting is that the extreme positive, over 40%, we had a lot more companies in that category. The extreme positive, which is again good news for investors. And some of the companies that were in that category is just quite remarkable. The best performing stock for the first half is this Silicon Valley company called Palantir. And what they do is they use computers to look at data and decipher the real thing from the noise. And they're used by the Defense Department and they're by CIA, whatever. They're very advanced in the way that they could use computers. And that was the best performing stock and about 80% up, 80% up in that stock. So wait, everybody wishes one. I put all the money in Palantir. Well, last year again, it mixes. It's all over the place. And then you had an energy company called NRG. So the same way that we had an energy company being one of the worst performers, we had one of the energy companies being some of the best performers. And then Newmont Mining, they're into gold. So you had a stake in that company, and that as gold went up, so did that stock price. So ultimately, it was good news for investors, a lot more on the positive side than the negative side. But ultimately, when you look at the performance, which is, as I said, about 6%, you somehow combine all these 500 different performance numbers into a single one. And the way you do that is not only by looking at the individual performance of each stock, but also the other thing that matters is how significant, how big is that stock in the market? And the larger stocks in the market are the ones that have a greater weight. Their performance is emphasized more. And that's why we get so often to the Magnificent Seven, these large seven stocks that have become known as the Magnificent Seven. And that is NVIDIA, that is Apple, Microsoft, Google, Facebook, Tesla, and Amazon. And what's interesting is that if you take these stocks aside and you look at them on the side, last year they did twice as well as the stock market. So they really, really did very well last year in 2024. In 2025, for the first half, they are still up, but they're up about 2.7%, which is less than half as the market as a whole. So in other words, last year they did better than the market as a whole. This year, these Magnificent Seven, they're kind of trending the market quite significantly. And they left a hole in the S&P. So when you look at the performance of the other stocks, the S&P 500 minus the 7, so the S&P 493, they're also up, but they're actually up quite significantly more, about 8%. So it is quite different than we saw last year. And I think that when we had this review, Joanne and Tyler, we did advise folks that let's just not overload on the Magnificent Seven. Let's still hold them, but not go gangbusters on them, because it's possible that their outperformance might not continue. And that's exactly what's happening this year. And they had a significant impact. I mean, if you look at the S&P, these Magnificent Seven stocks amount to roughly about a third of the value of the S&P. So a third of the performance of the S&P is driven by 7 stocks. And what's crazy is that the same exact 7 stocks are also part of NASDAQ at 53%, more than half. And again, if you do this, let's say you want to invest in NASDAQ, more than half your money, more than half of the performance in your portfolio is driven by 7 stocks. And that's a lot. That's very concentrated. So what we argued for is that let's hold these stocks. We don't want to miss out on them, but we want to not overload on them. And if you hold the same exact 7 stocks in a context of a global portfolio, which is what Forrest typically tends to do, you would have exposure to them, but only roughly at about 18%. And this year, there was a great validation because you're not overloaded on these stocks. And as these stocks are trading the market, you're doing better than NASDAQ, you're doing better than the S&P because you're not that overly exposed to them. So a lot of good news and a lot of the things that we talked about really coming to fruition and benefiting your clients for this particular year.
Right, so for 2025, what we can gather from the data you just showed us is that diversification really matters, and we're seeing it this year. So that's
Absolutely.
good news for definitely for our clients, because we are highly diversified across, the whole world, as well as small and
Yep.
small and big, and value and growth, et cetera. So,
Yep.
but even beyond though, market returns and market volatility for the first 6 months, Apollo, we've seen so much going on with tariffs. Can't forget about that and the volatility that drove. And that's certainly not over yet. I think it's just been
Right.
pushed off to August 1st at this point.
Right.
And as well as I was trying to think of one other thing that was, well, we've had the OBA, the big beautiful tax bill that just
Yep.
passed. I mean,
Yep.
a lot of noise regarding that. And with these market highs, I think I'm sensing from clients there's a little anxiety
Right.
about, is this truly going to continue? Do you have anything to say about that? Is this different in any way? Is there any changes people should be making to their portfolio or thinking about at this point?
Yeah, and no, that's it's so important what I just asked. And last time, did we talk about tariffs?
We did
We
talk
did.
about tariffs.
Yeah, we did talk about tariffs. So the first, the tariffs have been sort of on the table for investors to see for quite a while now. And I think that one of the things that we talked about last time is that whenever investors have an expectation about a tariff or about a policy coming from the government, that expectations tends to be incorporated into the value of a company, the value of a stock, almost like immediately. And nobody might know exactly what the implication will be, but whatever expectation of an impact is reflected in the stock price quite rapidly. In other words, we've had months to look at the tariffs and the impact on companies, and unless something new comes up, something that we did not expect, it's unlikely that the market at this point will be moved by things that are expected. So if the president decides to wake up one day and then do something that is really good for the economy, and let's say slow down the tariffs, well, that's unexpected and that might move the market up. If he wakes up one day and he says, no, I'm going to do the other way, it might go down. But those are unexpected moves. Anything that is expected at this point has been priced in. And Joanne, you talked a lot about volatility. So I want to come back to this idea of volatility, because volatility, what it basically means, that you see so much fluctuation from day to day, from week to week, from month to month in the stock market. And when you look at this, you might feel like there's something wrong with the market. There's something that's not right there. I actually have a different view. I really believe that the volatility, these movements up and down, are a sign of strength for the stock market, not weakness. Why? Well, if you look at a particular company and you see, boy, all of a sudden, unexpectedly, tariffs are being put in, their profits might be impacted. They're not going to make as much money. What exactly do you expect to happen to the value of the stock? Obviously, it's going to go down because it's not worth as much. So to me, the volatility is reflecting the fact that investors are assessing the prospects for profits down the road in a very quick way. And that's exactly what you want the market to do. You want the market to drop. It's not pleasant, but that's exactly what it ought to do. If the company's not going to make as much money, if Apple is going to be confronted with challenges in bringing iPhones to the country, what exactly do you expect to happen to the price of Apple? When all of a sudden good news is like, oh, great, they figure out something, well, the price is going to move up. So the volatility should not scare anybody, because the volatility is simply reflecting that, hey, there's something that we didn't expect that just came about. And I need to kind of reflect that in the value of a company. I need to reassess what that company is worth right now. So I think that's kind of what I want you to think about when you see the market going up and down, even if it's a big drop. There's nothing wrong with that. It's just, first of all, it's always been the case that the market does that, and secondly, the good news is that it's reflecting something that is consequential to that particular company. So to me, that again, the tariffs right now, I would not look at it and just say you need to make a move with your money because of tariffs, because all of that has already been priced in. And something that we talked about last time, which is that when you look at tariffs, it doesn't appear to be the primary driver of stock market performance because. For example, when you look at like the first Trump administration, we had a lot of tariff talks, and so much was being made about the tariffs and year day after day, trade war, and if you look at the performance of the U.S. stock market during that period, over 4 years in the first Trump administration, the market went up by about 80%. So despite all the trade wars and all that, we still did very well. But obviously, we're the country that was trying to impact others. We're trying to not hurt their economies, but we're trying to really show them that hey, this you can't play by whatever the argument might have been. And China was a big recipient of those tariffs. And what's really interesting is that for that particular period, the Chinese market actually outperformed the U.S. market, despite being the target of tariffs.
Interesting.
So if tariffs were indeed the primary driver of market performance, it's kind of hard to justify how come both the US and China did really well. And you look at this year, I mean, Tyler John, if you look at the S&P, it's up about 6%. And again, you look at China, the country that we are trying to impact the most with our policies and impact their economy. And you look at China for the year so far through June, it is up about 18%, 3 times as much as the US market.
Wow.
We were trying to go after the Canadians, our friends, the Canadians. Somehow we're going after them. And the Canadian stock market is up about 16%. Mexico, our friends to the south, we're going after them, and they're up about 30%. And then Germany, so much of the German economy is about exports, and yet they are up 35% for the year. So all these markets that are supposedly being hurt by tariffs, they're all doing really well, a lot better than the U.S., a lot better than the U.S. And if it was really true that the tariffs are the primary driver of market performance, why would we see something like this? So again, to me, it kind of goes to show that listen, you hear a lot in the news. It's very emotional. You're likely going to be impacted if the tariffs stick around when it comes to prices that you pay, availability of merchandise, quality of merchandise. There are going to be things that you will be impacted likely, product by product dependent. But it's likely that's going to happen if the tariffs stick around the way that they were announced. And we're going to pay more for that for things, and that could be the case. But the market is not really going to be driven forward by the tariffs. It's too many other variables that matter.
Great
So that's
recap.
on the tariffs, just to put people's minds at ease. It's not really the driver of the market. It's not something like it's made up to be like, oh, this is the biggest thing for companies will figure it out.
Great. Makes sense.
And you also touched on, I mean, I'll give you an example how companies figures out. Did we talk about the tariffs in the 60s when the Germans were selling us a lot of cars, the Bugs and the Beetles and the buses, and then we would send a lot of chicken to the Germans? You remember that?
Yeah,
We did talk
we
about that
did,
last
we
time.
did talk
I mean,
about that, yes.
that's just a clean to me look and say, listen, companies will try to figure it out. But he also brought up the other thing, which is the bill, the mega bill, right? Is whatever the name of it is,
Oh, well, one big beautiful act bill,
whatever,
something like
it's
that. That's the actual name too.
the triple B, it's the
Yeah,
big B, the BBB,
yeah,
whatever.
yeah.
And that's a different animal there because what that basically does, it basically the main features of that are basically just as a recap. Back in the first Trump administration, there were some tax cuts. It wasn't dramatic, but there were some tax cuts, and those were due to expire. And what they did is they said, okay, if we don't do nothing, these tax rates are going to go up by a couple of percentages depending on the tax bracket. So a little bit go up. And for some people, actually, maybe not, because one of the issues with the previous one was that folks in Illinois were not able to deduct the state and local taxes, and that was a big hit to a lot of folks in states that have a pretty high marginal income tax or property tax. Anyway, so it's a complicated thing, but ultimately, the Congress had a choice of do nothing and just let those kind of go and then just move on, so not do anything, or actually make those permanent. And by making those tax cuts permanent, and that was one of the big features of the bill, by making those cuts permanent, what that did is basically it deprived the government over the next 10 years from collecting roughly about $4.5 trillion in taxes. So right now, because the bill was passed as opposed to not doing anything, the government would collect about $4.5 trillion less in taxes over the next decade or so. So that was what the estimate is kind of pretty much across the board came out to be. Now, they're not going to collect as much money. So what's is there a balancing act there to kind of make sure that maybe we don't spend as much? So what they did is they said, okay, so let's make some cuts. And the biggest cuts were made by far the biggest cuts were made to a healthcare program for the poor that was run in conjunction with different states. That's called Medicaid. So it's expected that about 8 million or so people will be off that program that was providing healthcare for the low income citizens in different states. And by doing so, the expectation is that between that and other little tax savings, the government will basically get to keep more by about $1 trillion. So this mega bill, if you think about it, over the next decade is expected to kind of create a bit of a hole of about $3.5 trillion in the budget. And these are just well-known numbers. I'm just kind of putting out there whatever pretty much every estimate out there has been looking at. Now, how does this impact the market and companies? Not that much. Not that much, because these tax rates have been around for a long time, so they're not going to change people's behavior. If you get to see more money, maybe I change my behavior, but I'm going to get to keep exactly the same thing that I've been keeping for the last 4 years. So I don't think there's going to be a big impetus for people to spend more, so companies get more money. So it's going to be pretty muted. The cuts, not the tax, but the cuts to Medicaid. Most companies, you look at Facebook or McDonald's, Coca-Cola, they're not really going to be impacted by those Medicare cuts. Maybe some local hospitals and so forth, but by and large, not a big, impact on the economy and stock market as a whole. But it is expected that when you give people money, like they're going to keep $4.5 trillion, well, maybe that the economy is going to go up. And depending on who you listen to, that's going to be promoting growth in the economy. And because the economy is growing, you're also going to collect more in taxes. So part of this is going to be offset by the fact that we will collect more in taxes as the economy grows. And there are different opinions out there. I can tell you folks that depending on the folks you listen to, it's gangbusters or not. So I'm not here to tell you, believe what you want to believe. I think the nonpartisan estimates are that we will collect more in taxes that will offset roughly about 10 to 15% of the of this whole. So maybe it's not going to be $3.5 trillion, but maybe close to $3 trillion. But I think a lot of people agree that this is going to add to our national debt over the next decade, because again, we are not collecting as much in taxes, and the offsetting cuts are just not anywhere close to making that up. So that's just a big picture on the mega bill. Not really going to impact the market. There's not much there to impact the market, and on a day-to-day basis, nothing much is going to change. I think the biggest impact by far is going to be those about 6 to 8 million people who might not have health care, and unfortunately, those tend to be more of the low income. So that's probably who's going to feel the impact the most. Not necessarily clients of Forest Asset.
All right, well, thank you for mentioning all that on the big, beautiful bill and the recent uneasiness. But You did touch on something that we'd like to address, and that was the national debt.
Yeah.
So in recent weeks, the credit agency has downgraded the creditworthiness of U.S. government bonds, perhaps reflecting concerns of recent legislative proposals that could exacerbate our already substantial fiscal debt. And particularly for our clients, fixed income is the bedrock of their portfolio. And specifically, they invest a lot in U.S. Treasuries. So how concerned should we be about the national debt, and how are investors currently assessing its sustainability?
Yeah, no, that's absolutely, because that is the biggest impact. The biggest impact is not necessarily going to be on us. It might be on our kids or grandkids, or to the point that Tyler made, what if the bonds that we have right now are no longer sustainable? And I think that the really good news, in a way, the really good news that came from that particular bill is that the government had a limit on how much it can borrow. That's called the debt ceiling. So that once you reach that amount, the government can no longer borrow money. And that ceiling is really something that could be very dangerous in terms of not being able to pay interest on bonds. And this bill actually did move that up by about $5 trillion. So at least for a couple of years or so, we should be okay with the additional $5 trillion that we're allowed to borrow. So the first good news is that the biggest concern about you not getting paid interest on U.S. government bonds has been alleviated because the bill also included that increase in the debt ceiling. And that would have been, in the past, that was a really tough thing to deal with the current politics. But the good news is that that particular bill lifted it up. So now we can borrow money so we can pay interest. But let's kind of look a little bit at the debt and put some numbers to that. And if you look at the beginning of the year, in 2025, the U.S. government owed the comprehensive number over that we accumulated year after year has been about $36 trillion. So that's kind of the number. So if you want to know how much do we owe as a country, roughly $36 trillion with a T. A lot of money. Now, if you look in January of 2021, this is when President Biden came into the White House, that number stood closer to about 28 trillion, roughly speaking. So over the 4 years of the Biden administration, we added roughly about $8 trillion of debt that we accumulated over those years, which per year means that it's roughly about $2 trillion per year. That's kind of what's been the rate during the Biden years. And if you go back to the first Trump administration, it was a little bit less than 20, but let's just call it 20 just to make it easy. And that was about $20 trillion. So over the first Trump administration, we added roughly about 8 trillion, identical almost to the Biden years, which also means that it's about $2 trillion per year. And going back one more, Tyler, in 2009, right there, somebody from Illinois, President Obama, came in, and he was about $11 trillion when he came in the White House. So over his 8 years, so we're talking about 8 years now, during the Obama administration, we added 9 trillion. And because there are 8 years, it was about $1.1 trillion per year. So the reason I want to start there is because what you see is that it's been fairly consistent, the rate over the past 2 administrations that we've added to the debt. So it hasn't been like, oh, one party has been better or worse. No, it's exactly pretty much the same. And part of the reason for that is that when it comes to spending money, there are 2 different types of programs that the budget has. One is a set of laws that are required to be funded. So we wrote a law saying that we need to pay for the elderly health care, Medicare, Social Security. Those are programs that are written in law that the government has to fund. And those are called mandatory spending. And when you add the debt, the interest on the debt and the defense, it turns out that about 80% of the federal budget is already gone. It's already gone because it's either mandatory spending, interest, or defense. So what you left to play with in terms of trying to cut things, it's only about 20%. And that includes highways, that includes health, that includes education, that includes all the other things that the government provide, parks and so forth. So it's not that much that you get to play with because of these mandatory spendings. So that's been the issue that's been hard to really reduce the level of the debt. But the other thing that is quite interesting is that that number itself, the 36 trillion, it's not really the most meaningful number. It really is not, because the way the government borrows money is that they come to Joanne and say, hey, look, Joanne, if you give me $1,000, I will pay interest, and then after a certain period, I'll give you the money back. But when they need to give Joanne the money back, they can go to Tyler and say, hey, Tyler, give me $1,000, and they can take that money, pay Joanne, and roll the debt further down the road. The government can do that. Now, it turns out that in that respect, the number itself might not be the most meaningful metric of the burden, but rather, if you look at 2025 and we say we owe $36 trillion, and you go back to 1991 when we owe a fraction of that, and it turns out that back in those days, it was exactly a tenth, $3.6 trillion. The really meaningful number is how much does it cost us as a country to pay interest on that debt? Because that's the one thing that the government simply cannot avoid doing, paying interest on the debt. So what is that burden? And if you go back to 1991, it turns out that relative to the size of the economy, we were paying about 3.1% of the value of the entire economic activity in the country as interest on the debt. That was the percentage of the economic activity that went into paying interest on the debt, percentage of the US economy. Now, today we owe $36 trillion, 10 times as much. So what can that, percentage possibly be today? And it turns out the Fed actually has a website that publishes that data, and that number today is about 3%. It's a little bit less than that. So how can it possibly be? How can it possibly be that despite you own 10 times as much, it's not as burdensome? Well, first of all, everything goes up. The economy goes up, the people in society. So the fact that this number goes up shouldn't necessarily be surprising. The stock market today is probably 10 times greater than it was back in 1991. But the other big one, folks, that I think it's really important is that if you look at the numbers here, if you look at and say, well, we went from 11 trillion to 36. So between 2009 and 2024, we added $25 trillion. So over the past 15 years or so, we added the bulk of the debt. The bulk of the debt, 25 out of the 36, came over the past 15 years. And what's been remarkable about the last 15 years has been that we had the great financial crisis and we had the pandemic. And because of those events, the interest rates have been rock bottom. So the interest rates have been so low. And that's one of the reasons that this particular burden is not as great as people think, because we're able to borrow money at incredibly low rates. In fact, if you go back to 2021, this is before the rates started to go up. If you go back to 2021, this percentage was 1.5%. It was half of what it is today because, again, the rates were so low up until about 2022 when you start having inflation problems. So to me, the really important thing to know is that we have a big debt. The debt is partly due to the fact that it's hard to manage it since so much is mandatory spending and defense and interest. It's the bulk of the government spending. So it's not very easy to deal with that. On the other hand, don't be scared by the numbers themselves, because the numbers being large doesn't mean as much. It's the interest that we pay, and it has been going up. It went up from 1.5 to 3 as we had to refinance the debt at higher rates. And ultimately, the question that he asked is the right one. How do you know if this is sustainable or not? And you can listen to different opinions. I actually don't believe in any one opinion, but rather I believe in the voice of the market and how investors are voting, literally voting with billions and billions and billions of dollars. And what I mean by that, if the government wants to borrow money, it cannot force any of us to give them the money. They cannot force us at all. They can't. There's just no way. We have to voluntarily agree to give them the money. So when we give somebody money, we also want to be mindful of how much do we get paid in interest on that money. And not too long ago, today is about 4.3 or so, but not too long ago it was about 4.4%. So that was the rate on U.S. government bonds. And that was what investors received voluntarily. Now, it turns out that we did not have to give money to the government. The other entities were trying to borrow. Mickey Mouse, for example, was trying to borrow. And if you look at Disney, they were also looking to borrow, and they would have loved to pay 4.4%. But the market was saying, as much as you have ESPN and the parks and all that, a great company, you're not as reliable. I don't consider you to be as credit worthy as the U.S. government. And you can go down the line. Great American companies, Ford, for example, they would love to borrow at 4.4 or 5.5, but the market's saying, the car business is not as solid as the government. And Macy's, I mean, great department store, they can borrow money. It just costs them a lot more. It's about 8%. So to me, the way to assess whether or not the debt is sustainable for any entity that borrows money is to look at the relative interest rates. How much are they paying in interest? And I think that's the key here. It's not the credit agencies. It's just simply market voting with dollar bills. And as of now, the market signal is clear that despite all the big mega bill and despite all the stuff, they do believe that the U.S. government has the ability to manage its debt. And if there was a day when they would not feel that way, then the way you would see that is in the interest rate that the government would have to pay. And as an example, you have Brazil. Brazil is a great country. They can borrow money. It's just that investors don't feel confident that they manage their debt as well as the US, and they can borrow money, but instead of 4.4, they have to pay over 14% in interest. And that to me is the true signal. And as of now, I can tell you folks that the U.S. government still has the lowest interest. So it's not about a credit rating that can move. Like when you mentioned Moody's lowering the credit rating, it didn't do anything to the yield because the interest rate, because people already knew all that stuff. So a lot of times these credit agencies are coming too late, or I mean, some of them actually did it years ago. So it's not really the most reliable way, but rather look at the interest rate. And if this was to change, we'll have a webinar and talk about it, but it's not there yet.
So Apollo, it seems to me that the government has an incentive to try to reduce those rates. One, to pay less in interest, and two, it might spur growth. So it's kind of getting to the place that they want to be at anyway. So possibly looking at rate cuts. I know there's talk of 2 more by the end of the year, and we'll see, I guess.
Well, I also want to kind of touch on that for 1 second, Joanne, because it's a really important point you made. When you're talking about bonds and rate cuts and all that, folks, not all bonds are the same. So when you put paint all these bonds with the same brush, I'm not sure that's the best way to go, because what we found is that looking at numbers and historical data, we found a very clear relationship between the length of the contract that you have with that particular borrower, called maturity, and the interest rate that you receive on your money, also called yield. And what I'm saying is that if you lend the money to the U.S. government, let's say for 30 days, after 30 days you get your money back plus interest. The interest rate that investors have gotten traditionally is not as much, because you're dealing with the government. It's only 30 days, not a lot of risk associated with that. Now, if you lend the money for a year, well, your money is locked up for longer, and investors historically have asked for a bit more in interest to lend money for longer, which makes sense. It's intuitive. And that's kind of what you see if you look at 5 years. You want to get paid even a little bit more, and particularly when you go to 10 to 20 years, certainly you expect a bit of a higher interest rate. And if you connect all these dots, basically what you see is that, boy, this is what's technically called a yield curve, which is simply a line connecting these dots. And this has been the normal shape. Now, with the inflation that we saw in 2022 and the Fed trying to fight it, there are two things that happened that are unusual but not necessarily unprecedented. And the first one is that this very short rate went from close to zero to 5.5%. So a big jump, not as big as the 80s when it went from 0 to 18%. But the other thing that's unusual is now if you lend money for longer, let's say a year, you would have gotten paid less. If you lend money for 5 or 10 years, once again, you would get paid less. So you still had this, what's called an yield curve, but this is what's called inverted, meaning that it's a bit upside down. So the reason I want to touch on, Joanne, on your comment is that what the Fed does is fundamentally impacting the rates that are at the short end. So what it did last year, it's 3 times cut rates, but the rates that it cut impact only the very short-term bonds, the very, very short-term bonds. And the impact of those cuts is twofold. If you are a business that has to take an overnight loan, called commercial paper, to make payroll or just very short-term loans, that's really good news for you because you're not going to pay as much. On the other hand, if you have a certificate of deposit, CDs at a bank, those are required to buy these short-term instruments, and the rates on CDs have come down. And that's really important to know that the impact of the Fed tends to be much more on very short-term loans and CDs and money market funds. What about the longer term bonds, like let's say the 10-year bonds? Well, it turns out that it's surprising, but not necessarily what you expect. So if you look at the 10 years in the fall of 2023, they got to about 5%. So they're quite high for what it used to be. And then by August of 24, this is before the Fed cut any rates whatsoever. So the Fed had not touched the rates. Those 10-year yields had dropped to 3.6%, a huge drop without the Fed making any move, without any moves. And then by the end of 2024, well, these rates were cut by the Fed by about 1%, and yet these 10-year rates went up by about 4.4%. So boy, this is a bit of a surprise, isn't it? Because these rates were not supposed to go like this, completely in opposite direction or not at all related to what the Fed does. And this 10-year rate is really important for a lot of you folks, and it's not controlled by the Fed. It is not controlled by the Fed. Because as you saw, it dropped before the Fed made any moves. It went up after the Fed cut the rates. And the reason I say it's so important for so many of you is because if you look historically at this 10-year Treasury yield, which is the interest rate on these 10-year government bonds, and you overlay the mortgage rate, what becomes apparent is that the 10-year Treasury interest rate is pretty much the foundation. It's the backbone of the mortgage rate. And in that respect, it's the 10-year rate that a lot of you who are looking at real estate should care a lot more, and that is not driven by the Fed. So then what drives this 10-year rate? And to me, there are multiple factors, but one of the most significant ones, in my opinion, is the fact that when I lend the money for years to come, I wanted to at least be able to buy the same things that I'm buying today. So a lot of investors, when they deploy their money for years, at least they want to look and say, what do I expect inflation to be? And if I expect inflation to change, well, that should reflect in the interest rate on these bonds. So if you go back to September when we had a debate, and then you go to February when start talking about tariffs and the potential impact of tariffs, what you saw is that the expected inflation on average over the next 5 years had moved up by about 0.7%. And there was just people expecting that prices are going to go up. And the result of that is that the yield on the 10-year treasuries also went up, the interest rate on these 10-year bonds, and so did the mortgage rate. And this is without the Fed kind of making any moves. Anything, it made the cuts since September. So again, it to me, when you look at these longer term rates, they're not driven by the Fed. So if you're kind of holding your breath on the Fed to buy a house, I wouldn't be so sure. And the second and last point I will make on these interest rates, which I think it's really important, is that I showed you a second ago the graphic of the history of these 10-year rates. And where we are today at the end of June was about 4.2%. And, I can ask all of you, if you look just visually, does it appear that we are close to some super high level of interest rates historically? And it becomes obvious no. In fact, when you look at the average over the long run, that's closer to 6%. And we are now well below the long-term average. And the reason, in my opinion, that we think rates are so high is because of something called anchoring. That if you look between the financial crisis and when inflation started to move rates up, the average on the 10-year was 2.3%. So we got used to that very low rate, which in my opinion was pretty much an anomaly, not something that I would necessarily expect, driven by these two major events in the world. And we somehow believe that that's the norm. No, it's like you're in Chicago and it's a beautiful day in January and you can go out in your t-shirt. Well, don't get used to that. Don't toss away a coat. Just enjoy that and then just go back to wearing a coat. Because before the financial crisis, the average was closer to 7%. So to me, when people are saying, well, these rates are so high, I would like to get some perspective on that. It's just you're kind of missing the forest, from the trees from the forest. I mean, you have to look and just say the rates right now are higher than they used to be, but that to me was something that was awfully unusual. And I personally not sure that I would expect the rates to go back to 2%. We had two huge major global events that for years have kept the rates low. And unless something like that comes back, I'm not sure what I would expect that to go back to 2% because I think that was more of the anomaly than the norm.
Thanks for explaining that. That does make a lot of sense, and I think everyone will agree. Um, Before we wrap up, I think Ty has one other question he wants to kind of circle back to.
Yes,
Yep.
so, and this also was sent in by a client. And I think the reason that we have such a good relationship with Dimensional and yourself, Apollo, is that we have very similar, if not the same investment philosophies.
Mhm.
And this question kind of circles back to what you said earlier about the importance of diversification and international returns, particularly in Canada and Germany. But the darling of the ball this year has been international equities for the first
Yep.
half of the year.
Yep.
And I was wondering if you could kind of give some insight into why do you think that is happening? Is it earnings? Is it perhaps that they've underperformed the past couple of years? Does it have to do with the US dollar weakening? Could you delve in a little bit on that?
Yeah, I mean, and I think that's so I'll touch on a few of those, but I think that the one kind of caution is even as I go into this explaining is that there's not one single thing that would have made any of these stocks or stock markets go up in value. So I think trying to find one simplistic reason or one reason that drove it, it's too simplistic. So rather than that, what I'm going to suggest is that a lot of times when it comes to investing, people and investors are looking at prices and how much are you paying to buy something. In terms of, let's say, earnings, which is a metric that makes a lot of sense. If you own a piece of a company, you are entitled to part of the earnings. So how much am I paying to get those potential earnings? And it's quite possible that the expectation of earnings for some of these companies might have got up with the retrenchment of US trade. It's quite possible that they're saying, okay, well, fine. Like as the US retrenches, maybe that opens up markets for them somewhere else. It's possible. But what I would say it's really interesting about international markets, and we've advocated this quite a bit, is that the price that you pay to own some of these companies have been a lot better than the US. So let me just give an example. If you look at the beginning of the year, if you look at Tesla was selling for roughly about $400 a share at the beginning of this year. So if you have $400, you know what to do with it, buy a coat, or you can buy a share of Tesla. But what do you get for that $400. Well, you get to partake in the earnings of Tesla, pretty much like Elon Musk, not as much as Elon Musk, but the earnings associated with that share for a year at the beginning of 2025 are roughly about $4. So here's a way to think about it. You just spent $400 and Tesla theoretically comes and puts in your piggy bank $4 a year. So the very first obvious question is, how many years would it take for you to make your money back? You spend $400, you get $4 a year, not very complicated. It would take you 100 years. So maybe your kids and grandkids can partake in that. So it's a relatively high price for the earnings of that particular company. But let's say you don't buy into this hype of US stocks and you really want to diversify abroad. And instead of Tesla, you look at Toyota. You get a Prius or a Corolla. Well, roughly the same time, Toyota stock was not selling for $400 a share, but it was rather $200. And it wasn't basically $4 a share, it was 4 times as much. It was $16 per share. So in that respect, it would take you roughly about 12 years to make your money back. So one of the things that we've talked a lot about in the past is that when you look at this, let's hold Tesla because you never know. Like maybe they're going to have robocars and robots and robocops one day, maybe, who knows? But it's possible. So let's hold it. But we also kind of said, let's also have the international piece because it is a bit of a better deal. It's not necessarily just the US stocks, in this case, an example of the car company. So it is the valuations for these international stocks were a lot better in many cases than the US counterparts. But the other big thing that is kind of really apparent to investors these days is that companies can be based all over the world. And you can redraw a world map based on not landmass, but the value of companies that you can buy and sell in each country. And that's what the map would look like. The US economy is about 25% of the value of all economies in the world, but the stock market, the value of the companies available to invest for investors to buy, is about 65%. So you got about 3,400 different companies in which you can buy ownership, Apple, Google, Shake Shack, and so forth, and they're at 65%. And around the world, you have about 10,000 other companies that you can invest in. And I think that what's become interesting is that over time, the economies have gotten quite integrated. And in fact, if you look at buying ownership in companies, not countries, what becomes apparent is that when you form that portfolio, the title that you mentioned, you would have exposure to about 12,000 different companies, and you would have NVIDIA. And NVIDIA is a great example of a success story in AI. But again, what's been interesting for investors, and not to just realize, but to just be a lot more apparent, is that NVIDIA, for example, only designs the chips, but they don't make any of it. They have no manufacturing facility. And the only manufacturing facility that can produce their advanced chips is a facility in an emerging market country in Taiwan, and the only company that have to fight for factory space to produce those chips is Taiwan Semiconductor Manufacturing Corporation. And in order for Taiwan Manufacturing Corporation to actually produce the chips, they need a very specialized machine. And there's only one company in the entire world that can make that machine that TSMC uses, and that is an investment in the Netherlands, and it's called ASML. So the reason I bring this up is that what's becoming apparent right now is that you look at AI, for example. Who holds the cards in this global value chain? And it's quite possible that they all hold the cards, but TSMC can charge whatever price they want because there's no other place where NVIDIA can make the most advanced chips. You don't like my price, where else are you going to go? If ASML charges, and they charge right now about a third of $1 billion for a single machine, if TSMC is not willing to pay, well, where else are you going to go get it? So the idea is that there is a global value chain, and the U.S. is not the only player. And I think that's kind of what's reflecting right now is that they're global players, and if the U.S. retrenches from this global trade, these folks are still going to trade with each other. They might not trade with us, but they're still going to trade with each other quite well.
Well, thank you for that analysis, and also thank you for bringing up the World Map Index. I know that many of our clients here today were once prospects, probably in the old office conference room, and Joanne pulled out this matrix book. That's like the Bible here in our office. So yeah, thank you for that. And I think we're right at about time here, Apollo, and we just want to thank you for your time and for explaining the complex things going on in the world right now. We try and keep this very current with current events, and you're phenomenal as always. So thank you very much.
Been great fun talking to you. Always fun.
Really appreciate your time.
And
Thank you so
with
much.
that, guys, we're going to end the webcast. We also want to thank our clients that are here today, taking time out of, I think, a pretty nice day here in Chicago, and some of you are actually in other states as well. So if we didn't have the engagement that we have and the participation and the suggestions from you, we wouldn't put this together. So thank you very much, and I'm sure we'll see you soon.
See you next week.
Bye.
Take care.
Yeah, see you in a few weeks. Bye-bye.
Bye.